Special Market Voice, Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, joins us right now on the show. Mihir, good having you. Thanks so much for joining in. At the outset, can I ask you, a lot of people are starting to talk about, it's more of personal finance kind of a question, but a lot of people are talking about how a significant amount of money is moving into ULIPs and life insurance plans on the equity side, and not so much on the MF side as well. Are you seeing that? Is more money starting to come into the life insurance space on the equity side and more money for you to therefore manage?
Well, it tends to be a steady business, the life insurance inflows. So I don't think I can say that we've seen some kind of a spike. Frankly, at Max Life, we always had a more balanced allocation from the traditional versus on the traditional funds versus the ULIPs. So typically, it's been a 60-40 traditional ULIP mix for us. So that continues. The growth rates, which probably spiked around 12 months back to almost 25-30%, probably that has come down a bit, but still is a healthy growth because for us, the renewals business itself is such a large chunk. Then even if we don't sell new policies, the renewal premium is a significant chunk for us.
Okay. Having said that, so how do you believe you would want to deploy this sum of money in 2020? Would you stick to the tried and tested, or do you believe that 2020 will bring about some changes within your investment rationale or the spaces that you are looking at?
So broadly speaking, we invest as per the fund objective. So we have pure equity funds, balanced funds, and the pure debt funds. But probably a little bit of tweak in style, which has been forced, I would say, is the fact that you need to consider that liquidity is a bigger factor than it was ever before, especially the global liquidity. So some of the traditional parameters that we are looking at for valuations probably need to be tweaked a bit, and this premium for quality, large cap, etc., may continue as long as we continue to be dependent on global flows. For the value and the cheaper and the smaller stocks to go up, we need the domestic, broad basing of retail investors and the HNIs to come back in the market, which we haven't seen. So the Nifty is up 13% this year, but the mid cap and small cap indices are still down. So this polarization will continue till we are still dependent on global liquidity.
But let me come in on that, Mihir. What is the way forward? And perhaps if you have any sort of an outlook with respect to liquidity in the markets, because the RBI has already suggested that there has been a lot of moderation in liquidity.
Yes. So the good thing is that the RBI seems to be very serious about bringing rates down, the transmission mechanism to work better than it has in the last year. And this would typically impact the smaller companies a lot more. The interest component as a percentage of the PAT is very large for the mid-cap and small-cap companies. So if interest rates go down, this benefits them much more than the large companies. The large companies frankly have cash. They haven't been leveraging, at least, and they've been deleveraging the last 5 to 6 years. Sure. So there's no problem out there. The stress is really in the mid and small-cap and the SME, unorganized and organized sectors, which will be helping, which will be helped a lot by the RBI's move.
Okay, so Mihir, we move into another earnings season. Well, the first half has not exactly been stellar. What is your expectations, and based on how things are in terms of valuations, where is your allocation going towards?
So we are neutral on equities. Say 3 months back, we were kind of underweight on equities.
Okay.
But the fact that two events happened almost at the same time. One is that we got the corporate tax cuts on September 22nd.
Right.
And second is the Fed changed its stance from balance sheet contraction to balance sheet expansion. This happened roughly around the same time.
Right.
Because of that, we increased allocation to equities, and probably that's the stance going forward even now. Yeah.
Okay. Just wondering, the first 10 months of this calendar and the last two have been slightly different in that there has been arguably some bit of broadening of the rally from peak polarization of 64%. That too has come off within the Nifty 50.
Right.
But outside too, I mean, autos showed a bit of a bounce, metals started coming back. So we've seen some broadening.
Yes.
Would you believe that, I mean, it's difficult to take a call on which side of liquidity will support the market, but would you believe that by natural course, some of these broader market companies might start making a comeback, whether on the Nifty or whether on the top 100 or within the top 500?
Definitely, because you can't obviously have this kind of polarization forever. Something has to give, and it's either the mid caps and small caps have to start catching up, or the large caps have to correct. We hope the former is true, and we've seen a lot of pain. I think it's been almost 18 months of maybe around 20 months of pains for the mid and small caps, and we've seen an underperformance of almost 20 to 30%. the valuation premium that small and mid caps has started commanding has now come back to a valuation discount to the large caps. So pretty much that pain and correction and healing process is done. And now that we have a global liquidity very good supporting us, credit growth can't. I hope it can't get much worse than 6% or so. Yeah. It has to go up. So I think we have already formed a good low base to start off from. So there's pretty much nothing that can go wrong from here because we're already at a low base.
Okay. We have an interaction coming up with Abhishek Lodha, and I'm just wondering if those pockets which have done well, but the market is largely in its conversation ignored. Real estate, for example, and now I've spoken about this 6-7 times in the month of December itself, the kind of gains that the real estate index has shown. Do you like any of such pockets which you may have a contrarian view on? The market may not be fully in agreement, but you believe that there's fundamental reason to bet on these pockets?
The good or bad thing is that, real estate or NBFCs, those segments, have in the last few months been painted all with the same brush.
Right.
So, but now in the last 2-3 months, we are beginning to realize that within those segments or sectors, the market is beginning to differentiate. So in NBFCs, you have NBFCs which have no problems in getting liabilities, which have no problems raising deposits or money from banks, etc. And they are now, I think, moving ahead, thrusting ahead. Similarly, in the real estate space, not all real estate companies are leveraged. Not all real estate companies are in stress. So the good branded players actually are seeing record sales. You've seen brands from Bombay, which were pretty much unknown in, say, Gurgaon, launching in Gurgaon and getting record subscriptions because the customer thinks that he's going to get his product in time at the quality that is promised. So I think within real estate or within NBFCs, the stressed sectors, the market is already beginning to differentiate.
Right. Well, I also want to quiz you a little on the RBI's financial stability report also suggested that household savings see substantial risk at this point in time. If you are suggesting that things may improve, then what are those factors that may lead to improvement in household savings, because they are naturally very important as far as investments in any area is concerned?
So essentially, we need to kickstart this job creation cycle, which has been elusive for so long.
Right.
And that cannot happen without private sector investments. The government has been spending on infrastructure, on roads, to the extent that they can. But the point is that not more than 20% of total investment in the country is created by the government.
Right.
80% is still the private sector, households as well as corporates, investing money either in physical assets like real estate or factories and buildings and all that is there for commercial. So to get the private sector cycle back in track is number one priority.
Okay.
That creates jobs, and that will automatically raise the level of savings in the country. Right now, we run a trade deficit. Every time the government stimulates, the only part that gets stimulated is the consumption. And when we have increased consumption, we start importing stuff. And that's an unsustainable cycle.
Okay, so generally speaking, where does your preference lie between consumer discretionary and consumer staples right now?
As of now, the balance would be in favor of discretionary, especially the auto space, because again, we get high frequency numbers, and there is an indication that the rate of negative is already coming off.
Right.
So November, of course, was less negative than before. We had good Diwali sales, and the inventory clearing, the year change effect, etc., is kind of coming to an end. So we should see some pickup there in the two-wheelers as well as the four-wheeler space, the car space.
Okay. Do you think those benefits will percolate down to ancillary stroke financiers as well, or they will be the last port of call?
No, it should. They all move together. Ancillaries may actually be an even better case than the auto companies, because a lot of the ANCs are also global in nature. And we have seen even the global cycle pick up, especially the China angle and the US angle, which was kind of sluggish for quite some time, is actually beginning to see some traction. So some of the global auto ANCs, which have local and global presence, may actually do better than the local autos.
Okay. Mihir, before we let you go, one piece of advice for 2020.
Stay with the volatility. Volatility is here to stay. We have two big factors. One is global liquidity. Second is a beginning of coming out for India. The beginning of the cycle turning gradually, probably. So it's going to be two forces acting against each other in the very short term, and that's going to create volatility. But I don't think the India's long-term story is gone. And so one must stick to their asset allocation to the extent they have committed to equities, and stick to it for the next year. Stick to the volatility. That's what I would say.
Okay. bear the pain and continue to stay invested, I reckon. That should be the big takeaway there.
Yep. Thanks, Mihir, for joining in today, and wishing you and your team fabulous 2020.
Thank you so much, and wishing you and your viewers a very happy 2020.
Thank you so much.
Thank you.
That's an important market voice, Mihir Vora, talking about his thoughts on what to do in a scenario like this.